to At the Coalface. My name is Roy Thompson of Carpenter Box Financial Advisors. Today I've got with me James Giblin. James is an investment manager at LGT Vestra. So good afternoon to you, James.
Hi, Ryan.
It's good to see you again. I think there's quite a lot of excitement, I guess, in the country now with where we are with the Euros. Just previous to coming on here, you and I were talking about the potential success of England football team, and we'll wait and see what happens on that front. But from an economic point of view, I guess more imminent is the 19th of July, with the proposal that further restrictions will be, or the last of the restrictions will be eased by the government, and we'll wait and see if that happens. As we speak, there is still seemingly a spread of the latest variant, although hospitalisation rates and death rates are not going up at the same pace. So I guess we're fingers crossed that those restrictions are eased in some way. And so I guess, what does that mean then, James, do you think, for the hospitality industry, certainly, that's been badly affected, the travel industry, which still seems, I think that's, very likely that will still be affected for the course of the rest of the summer at least. But I've certainly heard examples where hospitality sites perhaps have struggled to recruit staff. So we're now seeing some sort of knock-on effects that we wouldn't necessarily have thought of before. What's your view? What's LGT Vestra view of, if you like, the hospitality sector and the sectors that people might want to be considering from an investment perspective?
Sure. So travel's quite a complicated one. You've got at the moment Angela Merkel trying to veto various countries allowing UK citizens in, which could be a bit of a shame for some of our summer holidays. We might see you all in Cornwall, I guess, but hopefully we'll be celebrating the England victory at the Euros whilst we're there. So travel's maybe slightly more complex, maybe an easier one to talk about, and one that's maybe a bigger sector in terms of employment is hospitality. I think it's quite anecdotal, but maybe a lot of people have noticed the amount of job advertisements. You walk down the high street, there's a huge amount of restaurants advertising for jobs. Yeah. It's quite anecdotal, but it's certainly one thing that the hospitality industry has been highlighting. And there are obviously quite a few different reasons behind this. So you can choose 5-10 reasons why this could be happening. One of the ones that I think is maybe less understood and less appreciated is just the uncertainty that's in the sector. If you've been on furlough for the last year, or you found another job, say you're working in an Amazon warehouse, or just somewhere that's a bit more secure, would you really want to take a job in a restaurant or a bar where, all being well, we won't go back into lockdown and they closed, but there is some more uncertainty with that? So would you want to take a job that's less certain? There's other issues, of course, so Brexit and migration. A lot of EU citizens went home at the start of lockdown, and now obviously there's visa problems. So just getting that employment sector back has been quite difficult. Furlough schemes are another one. You're getting paid to sit at home. There's less of an incentive to come back in. How much of a difference that's actually made, I don't know. But that could be another factor. Another one as well is employees who work in the kind of sectors have had a long time to think and really about what they want to do in their career. Do they want to go back to work in these jobs that are unsociable, they're tough physically? Do they really want to do these? And they've had that time to think about it and possibly even retrain. I was reading a story earlier about having a few different interviews with people who are chefs who've quit and just retrain other jobs, like an electrician, really getting a different trade under their belt. So just taking the opportunity to do that.
For some people, the length of time of the lockdown, or I say lockdown, but over the last 18 months now, it does actually give someone an opportunity to have gone through a good period of retraining. And if you've been off on furlough, then, what great opportunity to do that, if there's nothing else you can do almost. So
yeah, absolutely. There are some parts of it that may be temporary. Obviously, all these bars and restaurants are opening at the same time. So there's a huge amount of demand for these kind of workers that will fall away. And these issues in hiring in that kind of sector may just fall away a bit. It's just a really unprecedented time in terms of hiring in that sector. We did actually see earlier today US payrolls. US non-farm payrolls came in quite a bit above what was expected. So that's maybe indicating that some of these issues with rehiring are falling away. But again, that's one to watch as we move forward.
Yeah. So the hospitality sector, some challenges still. So I guess the question then becomes, when you're looking at investments, where's the focus just at the moment?
So since the beginning of June, we've seen maybe a swing back towards quality and growth. Since November, we've seen in markets. So November was when we had the vaccine approval and the kind of reopening trade started. So instead of buying these really high quality growth companies, we moved in the other direction. Investors wanted banks and financials, materials companies, miners, all these kind of companies that screen as cheap, but have really been out of favor since the beginning of the pandemic. So what I mean with these kind of quality businesses, are these kind of businesses held in things like Lindsell Train, Fundsmith, these funds that are these huge funds that are well known to investors and retail investors. They buy kind of businesses that have really strong balance sheets, so not a lot of debt. They generate a lot of cash flow. And maybe most importantly, what I mean by quality is having really wide economic moats. The kind of companies they own are things like Unilever and Diageo, these massive companies that have really strong brands. That means that regardless of the economic environment, that they can churn out good profits. So these are the kind of businesses that have been in favor since the beginning of June. And now year to date, the kind of reopening trade and this move back to quality have pretty much cancelled each other out. So that's kind of what we've seen over the last month or so.
So what you're saying really is, at the end of with the vaccine coming back on stream, people were saying, okay, well, the banks and the miners have all gone down quite significant in value. So there's some opportunity there, and people were buying them up. That was driving the price back up. And over the last perhaps month or so, as an investment house, you've seen in the markets that people are, they're perhaps saying, okay, well, I'm going to take my profits that I might have made in those few months and move back towards the companies where I can see good line of sight over kind of future revenue streams, I guess. And, there's lower risk, so they're not highly leveraged or, they haven't got huge debts that they're carrying or anything of that nature.
Yes, spot on. There's maybe been one other part of it as well is the inflation side of things. It's one that we've talked a lot about on here.
Yeah.
But some of these big inflation indicators have come off a bit. So a lot of metals prices have come off. Lumber, which has been one that's been incredibly expensive, has fallen back quite a lot since its highs.
Yeah.
So there's quite a lot of indication. We've been talking about it for a while that inflation is going to be transitory.
Yeah.
So there are some early indicators that it will be. So that's maybe stopped that reopening trade continuing onwards.
Yeah. Okay. So in terms of moving forward, you mentioned that's over the course of the last month or so, you've seen that trend. Do you feel that trend will continue through the summer as we go into sort of reopening and I say reopening, but further reopening, I guess, from where we are now? You as an investment house see that picture will continue, do you?
Yeah, definitely. I think what one point to note is that we've seen a huge amount of economic growth, and that will likely tail off. We're not going to see the kind of amazing figures that we've seen in Q1 and Q2. And at this point, as I said before, we want to focus on really quality businesses. These are the ones that aren't really expensive growth names. So they're not your Tesla and these kind of businesses. These ones that produce good cash flow, aren't too expensive, and are just all around good businesses. That served us well last year. We see it as also being quite cognizant of risk, rather than going out there and buying these cheap names that could do well, but do face some structural challenges. So It's about managing the risk as well as that total return on the upside.
Okay, that's great. Well, James, that's been really good of you to join us today, and I'm sure we'll speak again in due course. But for now, thanks very much for your time.
Cheers. Thanks, Frank. Speak soon.